the exchange NSE provides trading in 4 different segments. One is wholesale debt market segment, 2 capital market segment, 3 futures and options, and 4 currency derivative segment as given in this particular picture. Now, let us try to go in detail about these 4 segments. The first segment, as we have indicated, it is wholesale debt market segment, popularly known as WDM. This segment at NSE has commenced its operation, started its operations in June 1994. It provides the trading platform for wide range of debt securities, which includes state government and central government securities like treasury bills, PSU bonds, corporate debentures, commercial papers, and certificate of deposits, etc. Now, coming to capital market segment. In this segment, the operations have started in November 1994. All these segments which have been started in certain time frame are important also from the examination point of view. It offers a fully automated screen based trading system known as National Exchange for Automated Trading NEAT system. Various types of securities like equities, warrants, debentures, etc. are traded in this particular NEAT system within the capital market segment. Coming to futures and options segment. This segment provides trading in derivative instruments like index futures, index options, stock options, and stock futures, and commenced its operations in NSE during June 2000. Finally, coming to the 4th segment, that is the currency derivative segment, CDS segment. This segment started its operations on August 29, 2008 with the launch of currency futures trading in US dollars and Indian rupee pairs. Trading in other currency pairs like Euro INR, that is Indian rupees, Pound Sterling Indian rupees, Japanese yen Indian rupees was further made available for trading from February 2010. Interest rate futures was another product which was made available for trading on this segment with effect from 31st August 2009. Now, we have discussed the various segments which are offered for trading at NSE through this particular NEAT system. Now, let us come to reforms in Indian securities market. Over a period, Indian securities market has undergone remarkable changes and grown exponentially, particularly in terms of resource mobilization, in terms of proper intermediaries, in terms of number of listed stocks, the market capitalization, the turnover, and investor population. We will now try to get into more and more details about these things and the principal reforms which have taken place in the Indian securities market since 1992. First, creation of market regulator. Second, screen based trading. Third, reduction of trading cycle. Fourth, equity derivatives trading. Fifth, demutualization. Sixth, dematerialization. 7, clearing corporation. 8, investor protection. 9, globalization. Then launch of India's volatility index. Direct market access, launch of securities lending and borrowing scheme, launch of currency futures, then ASBA, application supported by blocked amount, launch of interest rate futures, issue of capital and disclosure requirement regulations 2009. Now, we will now try to go into one by one reforms which have taken place in this particular Indian securities market. The first one, creation of market regulator. SEBI, popularly known as Securities and Exchange Board of India, the securities market regulator in India, was established under SEBI Act 1992 with the main objective and responsibility for 1. Protecting the interests of investors in securities, 2. Promoting the development of securities market, 3. Regulating the securities market. Now, coming to the second reform, that is the screen based trading. Prior to setting up this screen based trading system, there was an open outcry system which was followed for trading at NSE. That system was inefficient, time consuming because of its inability to provide immediate matching or recording of trades. In order to provide efficiency, liquidity and transparency, NSE introduced nationwide online fully automated screen based trading system, which is SBTS, on the capital market segment on November 3rd, 1994. These particular online fully automated screen based trading systems will be discussed further in detail in the later topics. Now, the third reform, reduction of trading cycle. Earlier, trading cycle for stocks based on type of securities, it used to vary between 14 days to 30 days, and settlement involved another fortnight. So, it used to take almost a month to get the shares what you have bought. The exchanges, however, continued to have weekly trading cycles which enabled shifting of positions from one exchange to another exchange. It was made mandatory for all exchanges to follow a uniform trading weekly cycle in respect of scrips under rolling settlement. In December 2001, all scrips were moved to rolling settlement and the settlement period was reduced progressively from T+5 and T+3 days. Now, from April 2003, T+2 settlement cycle is being followed. That means, today if you buy any shares, you will be getting the shares on the third day. That is, suppose you bought on 1st of January, you will get the securities on 3rd of January within into your account. Equity derivatives trading. This is another reform. In order to assist market participants in managing their risks better through hedging, speculation and arbitrage, the Security Contracts Regulation Act was amended in 1995 to lift the ban on options in securities. Trading in derivatives, however, took off in 2000 with index futures after suitable legal and regulatory framework was put in place. The market presently offers index futures, index options, single stock futures and single stock options. Demutualization. Historically, stock exchanges were owned, controlled and managed by the brokers themselves. In case of disputes, integrity of the stock exchange was suffering. NSE, however, was set up with a pure demutualized governance structure having ownership, management and trading with different sets of people. Currently, all the stock exchanges in India have a demutualized setup. Other reform, dematerialization. As discussed earlier, the old settlement was inefficient due to time lag for settlement, physical movement of paper based securities, all these issues. To meet these problems, the Depositories Act in 1996 was passed to provide establishment of depositories like NSDL and CDS in the securities with the objective of ensuring free transferability of securities with speed and accuracy. The two depositories are NSDL and CDSL. They have been set up to provide instantaneous electronic transfer of these particular securities. Dematerialized securities settlement has eliminated bad derivatives and associated problems. To prevent physical certificates from sneaking into circulation, it has been made mandatory for all newly issued securities compulsorily traded in dematerialized form. Now, the public listed companies making IPO of any securities of more than 10 crores have to make the IPO only in dematerialized form. Now, the other reform, clearing corporation, the anonymous electronic order book which are being followed at NSE did not permit members to assess the credit risk of the counterparty and thus necessitated some innovation in this particular area. To address this concern, NSE has set up the first clearing corporation, that is the National Securities Clearing Corporation Limited, which commenced its operations in April 1996. Now, the investor protection. In order to protect the interest of the investors and promote awareness, the central government through Ministry of Corporate Affairs established Investor Education and Protection Fund, that is IEPF, in October 2001. With the similar objectives, the exchanges and SEBI also maintain investor protection funds to take care of investor claims. SEBI stock exchanges have also set up investor grievance and investor service cells for redressal of investor grievance. All these agencies and investor associations also organize investor education and awareness program. Globalization. Indian companies have been permitted to raise resources overseas through issue of ADRs, GDRs, FCCBs and ECBs. Further, FIIs have been permitted to invest in all types of securities, including government securities, and tap the domestic market. The investments by FIIs enjoy full account convertibility, that is the capital account convertibility. They can invest in a company under portfolio investment route up to 24% of the paid up capital of the company. This can also be increased up to the sectoral cap or statutory ceiling as applicable to the Indian companies concerned by passing a resolution of its board of directors, followed by a special resolution to effect by its general body. The Indian stock exchanges have been permitted to set up trading terminals even abroad. The trading platform of Indian exchanges is now accessible through internet from anywhere in the world. RBI permitted two-way fungibility for ADRs, GDRs, which means investors, especially foreign institutions or domestic institutions who hold ADRs, GDRs, can cancel them with the depository and sell the underlying shares in the particular market. Now, launch of India's volatility index. Volatility index is a measure of market's expectations of the volatility over the near term, that is the movement of the particular securities in the near term. It measures the amount by which an underlying index is expected to fluctuate in the near term based on the order book of the underlying index options. India's first volatility index, that is India VIX, based on Nifty 50 index option prices, was launched by NSE in April 2008. Direct market access. This is another reform. In April 2008, SEBI allowed direct market access facility to the institutional investor. Direct market access allows brokers to offer their respective clients direct access to the exchange trading system through brokers' infrastructure without manual intervention by the broker. Launch of securities lending and borrowing scheme. This is another reform which is started in 2008 April. The securities lending and borrowing mechanism was allowed. It allows market participants to take short positions effectively with less cost. Launch of currency futures. On August 29, 2008, NSE launched trading in currency future contracts in USD INR pair for the first time in the Indian securities market. Trading in other currency pairs like Euro INR, Pound Sterling INR and Japanese Yen was further made available for trading in March 2010. Now coming to ASBA. Application supported by blocked amount is a major primary market reform. It enables investors to apply for IPOs, FPOs and rights issues without actually making a physical payment. Instead, the amount is blocked in the investor's own account and only an amount proportionate to the shares allotted to these particular applicants goes out when allotment is finalized. Launch of interest rate futures. On August 31, 2009, futures on interest rate was launched on the National Stock Exchange. Now, issue of capital and disclosure requirements regulations 2009. In August 2009, SEBI issued issue of capital and disclosure requirement regulations 2009, replacing the disclosure and investor protection guidelines of the year 2000. So the ICDR regulations 2009 would govern all disclosure reforms or norms regarding issue of securities. So these are the various major reforms which have been introduced in the Indian securities markets, which are providing transparency, speed, accuracy and protecting the investors from all respects and also to the issuers by providing a vehicle for mobilizing the investment for their projects.